Hey everyone, welcome back to the channel. If you've been watching the US software sector lately, you're probably feeling like this. Adobe down 43%. Salesforce down 42%. ServiceNow absolutely crushed with a 46% drop. Workday down 44%. This doesn't look like a normal correction. It looks like a massacre. But here's the real question. Is this a value trap or a once-in-a-cycle buying opportunity? In this video, I'll use 11 institutional grade charts to give you a clear answer from 4 dimensions: valuation, earnings quality, analyst sentiment, and risk matrix. Let's dive in. First, let's look at the big picture. From the market landscape view, you can see the software sector has been decimated over the past year. Look at this monthly returns heat map. Starting from November 2025, the sector entered a sustained negative return zone. From the orange zone in November 2025 to the deep red in January and February 2026, this shows selling pressure is intensifying and possibly accelerating. But more interesting is the valuation growth mismatch. Look at this valuation growth matrix. X-axis is revenue growth, Y-axis is P/E ratio. Ideal stocks should fall in this bottom right, high growth, low valuation. I call this the sweet spot. But the reality is, Microsoft is here, PE around 25 times, growth 15%, sitting comfortably in the sweet spot. Adobe is also here, with even lower PE around 15 times. But Snowflake and Palo Alto Networks, they're still hanging here. High valuation, high volatility. What does this tell us? The market isn't selling indiscriminately, it's repricing. High valuation growth stocks got hit hardest, while real cash cows are being mispriced. Next, the key question. Have these companies' fundamentals really deteriorated? Look at this profitability waterfall, comparing operating margin, that's the blue, and FCF margin, that's the orange. Microsoft, operating margin, 47%. FCF margin, 18%. A textbook cash machine. But look at Oracle. FCF margin is negative 16.7%. Red arrow warning. Snowflake is worse. Operating margin, negative 27%. Although FCF margin shows 29%, that's propped up by stock compensation and accounting adjustments. Unsustainable. Profitability quality has seriously diverged. This isn't a sector problem. It's a stock-specific problem. Let's dive deeper into fundamentals. Look at ROE decomposition. This black line is ROE. Microsoft's ROE is as high as 35%, from balanced contribution of healthy margins, asset turnover, and financial leverage. Snowflake's ROE? Negative 20%. Pure cash burning. Now look at market sentiment. This analyst sentiment gauge shows upside to price targets. Palo Alto Networks, 34.8%. Just entering buy zone, lighter green. Microsoft, 48.5%. Snowflake, 52%. Adobe, 56.7%. But Intuit, 92.2% upside. What does this mean? Professional investors believe the current crash has over-reflected pessimistic expectations. Analysts see value, but the market is still panicking. PEG ratio ranking tells more. Lower is better. This green line is fair value PEG equals 1. Yellow line is warning threshold PEG equals 2. Intuit's PEG is only 0.67, severely undervalued. Microsoft and Adobe both at 1.50. Below 2.0 warning line, reasonable. But Palo Alto Networks PEG is 6.69, Workday 4.84, Snowflake 3.91. Even after dropping 40%, these stocks still aren't cheap. Valuation risk hasn't cleared. Before investing, we must know what risks we're taking. Look at this risk heat map. Here I evaluate 4 dimensions: valuation risk, macro risk, execution risk, competitive risk. 1 is green, low risk. 5 is red, high risk. Let me quickly explain how this table is built. This is an institutional grade risk framework. First, valuation risk. Based on P/E percentile, rank all stocks P/E, bottom 20% gets 1, top 20% gets 5. Higher PE means greater valuation bubble risk. Second, macro risk. Based on beta coefficient. Beta less than 1 gets 1 to 2, defensive. Beta 1 to 1.5 gets 3. Beta greater than 1.5 gets 4 to 5, aggressive. Higher beta means more sensitive to market volatility. Third, execution risk. Based on operating margin, but inverted. Lower margin means higher execution risk, higher score. Snowflake's negative margin gets high score here. Fourth, competitive risk. Based on analyst upside potential, also inverted. Smaller upside means fiercer competition or harder to tell growth story, higher score. Okay, back to this chart. Look at specific results. Microsoft, valuation risk 1, macro risk 2, execution risk 1, competitive risk 5. Except AI side being too crowded, everything else is green light. Snowflake, valuation risk 5, execution risk 5, double red lights. High valuation plus negative margin, dangerous combination. Palo Alto, valuation risk 5, competitive risk 5. Cybersecurity sector is undergoing tech paradigm shift. Moat is shaking. Most surprising is Oracle. Macro risk 4, but execution risk only 2. Larry Ellison's AI transformation narrative is being validated, but you need nerves of steel to hold it. Risk-return perspective is clearer. X-axis is annualized volatility. Y-axis is total return. Ideal state is bottom left. Low volatility, positive return. But past year, everyone is negative. Microsoft closest to break even. Lowest volatility, 26%. Oracle is here. Volatility, 61%. Return, -7%. Isolated high volatility name. Palo Alto and Zscaler cluster here. 35 to 45% volatility, -15% to 20% return. Risk pricing is efficient, but efficient doesn't mean attractive. Portfolio construction perspective. Bottom left is correlation matrix. Look at this column. Oracle's correlation with other stocks is only 0.13 to 0.39, the lowest. While Adobe, CRM, ServiceNow correlations are as high as 0.69 to 0.76. Oracle provides valuable diversification. Finally, a cheat sheet summarizing key metrics. Volatility ranges from Microsoft 26% to Oracle 61%. Huge span. Max drawdown from 27% to 58%. Intuit and Oracle over 50%. CAGR all negative, but that's in the past. We care about the future. On timing. Look at this price trend comparison. All normalized to 100. First half 2025 rebound, second half consolidation, early 2026 accelerated decline. Sectors still in downtrend. Liquidity pressure not yet relieved. Don't try to catch a falling knife. But set target prices and build positions gradually over 3 to 6 months. Let's answer the opening question. Trap or opportunity? Accumulate. Microsoft, Adobe, Intuit, Oracle, solid cash flow, historically low valuation, peg below 1.5. Watch. ServiceNow, Workday, Zscaler, Analyst Sentiment optimistic, wait for earnings inflection confirmation. Avoid. Snowflake, Palo Alto Networks, valuation risk not cleared, earnings quality questionable. Remember, in software, real risk isn't short-term volatility, it's permanent business model damage. As long as AI transformation continues, enterprise digital spending won't disappear. These leaders will come back. The question is, do you want to be positioned when they come back or still watching? At the end of this video, let's throw out a little challenge. Right now, imagine you've got $10,000 in your hand. If you follow this exact investing approach we just talked about, how much do you think your net worth would become after 3 years? We'll reveal the full portfolio breakdown and the actual numbers in the next video. That's today's analysis. If you hold software stocks or are considering bottom fishing, hope this gave you useful frameworks. Remember, charts don't make decisions for you, but they help you avoid stupid ones. Tell me in comments which software stock you like most and your entry price. If you found this helpful, hit the like button and subscribe for more institutional grade analysis. I'll see you in the next one.